Welcome back to the deep dive. We've taken that huge stack of source material you shared on Applied Digital, and we're here to distill the core, the really volatile truths you need to understand this story.
And it is a story that's unfolding right now. We're analyzing this in real time as of today, November 13, 2025.
Yeah, you're basically watching history happen with this stock. Today, it's just in a free fall.
It is down over 10% intraday, closing at $23.625 per share.
And what's driving this? What's the trigger?
It's a huge announcement. Staggering, really. All about new financing, a massive new package that's designed to fuel their construction pipeline.
And that's the ultimate tension here, isn't it? This company, APLD, they've pulled off this incredible, this radical strategic pivot.
Absolutely. They've secured a colossal, just jaw-dropping, $16 billion contracted revenue backlog. That's the dream. That's the rocket fuel.
But to get there, they need cash now, and a ton of it.
Multi-billion-dollar price tag. And it's not cheap money. It's paid for with highly expensive capital.
So the financing news today just perfectly sums up the risk, the binary nature of this whole thing.
It really does. It's a make-or-break moment, and it's crucial for any investor, current or prospective, to really get a handle on it.
Okay, so that sets up our mission for you in this deep dive.
Right.
Is this stock collapse, which is being driven by this proposed, $2.35 billion debt offering?
And a massive equity draw on top of that.
Right. Is this the final fatal dilution of a cash-burning house of cards, where the debt just eventually crushes all the common equity? Or is this the last best chance to invest before that $16 billion revenue stream finally ignites?
That's the question. We're here to unpack APLD's transformation, drill into the really complex financials, and figure out which of those two wildly different scenarios, the $16 billion vision or the cash furnace reality, is the more likely outcome.
Okay, let's unpack this. We're going to start with the foundations, the business itself, its leadership, and its current financial reality. Part 1, chapters 1 to 3. Business, Management, and Financials. Chapter 1. Business Understanding.
So the first, and I think the most crucial thing you have to grasp, is APLD's radical pivot. This is a company that has completely changed what it is.
From one commodity business to another, essentially.
Exactly. They moved from hosting data centers for cryptocurrency mining to becoming what they call an AI landlord, a highly specialized infrastructure business.
And it's important for you to remember that the past is still dragging on them financially. It's actually astonishing. But their old crypto business still accounts for 93% of their current revenue.
And that 93% comes from a single customer A.
A single customer. That's incredible risk right there. And that legacy revenue is what? Barely growing?
Barely growing and highly volatile. But that's the past. The future is pure infrastructure. They design, they build, they finance, and then they operate these facilities they call AI factories.
And these aren't your typical data centers.
Not at all. These are next-generation, high-performance computing HPC data centers. They are purpose-built from the ground up to host the incredibly power-hungry, high-density AI chips that, hyperscalers and big LLM developers need.
So they're not selling the AI, they're selling the building. They're selling the land, the power, the specialized cooling, basically the real estate for AI.
That's the model, the AI landlord. And this focus on infrastructure is so intense, they're actually willing to get rid of their fastest growing segment.
Which is the high-margin cloud services arm, right, where they were offering GPU as a service.
Exactly. And to a growth investor, that sounds completely counterintuitive. Why would you sell off your fastest engine?
It seems crazy on the surface.
But it's a move that's rooted entirely in strategic clarity. Management felt it was necessary to execute this AI landlord vision without any distractions.
Okay, so what are the reasons? Our sources point to 3 specific ones.
Right. First, and this is a big one, was customer conflict. They're massive tenants, a company like CoreWeave, they're also cloud providers. So APLD's little cloud business was seen as direct competition.
So it was creating friction.
That's the word management used, friction. And it was getting in the way of securing these multi-billion-dollar, very long-term lease agreements. They had to choose, and they chose the bigger, stickier revenue stream.
Makes sense. Okay, what's the second reason?
Secondly, they're going for valuation clarity.
So they want the market to see them as one simple thing.
Precisely. If you're running a dual business model, one part is a stable, predictable, almost real estate-like landlord business, and the other part is this volatile, high-growth tech cloud provider. It just creates noise for analysts.
It muddles the story.
Management believes it muddles the valuation.
Yeah.
Yeah. It stops the market from giving them those high, stable multiples that pure play infrastructure companies usually get.
And the third reason, which feels like the long-term end game, is the REIT goal.
This is the big one. By getting rid of the volatile operating business of cloud services and focusing just on that long-term stable lease income, APLD is clearing the path for a potential future conversion into a data center real estate investment trust, a REIT.
And for anyone who doesn't know, why is becoming a REIT so important?
It's a critical move for a company like this. REITs have to distribute a high percentage of their income as dividends, but in return, they attract huge pools of institutional capital. And most importantly, they get access to a significantly lower cost of capital.
Which, as we're about to see, APLD desperately, desperately needs.
Desperately. And the market often gives premium valuations to pure play REITs because that cash flow is so predictable.
So when we talk about scale, APLD is not messing around. Their stated ambition is to be a gigawatt scale developer.
That's a completely different league from their crypto past. And their contracted pipeline, it proves they have the ambition and the customers to back it up.
We're talking about 2 massive campuses in North Dakota.
Yes. First up is Polaris Forge 1 in Ellendale. That's a 400-megawatt campus, and it's fully leased to CoreWeave.
That CoreWeave deal is really the bedrock of the whole bull case, and we have to highlight that they hit a huge execution milestone.
The critical one, the Ready for Service, or RFS status. They achieved that on October 27, 2025, for the first 50-megawatt phase.
And that RFS date is so important because it's the ultimate proof of concept, right?
It is. The entire investment thesis is based on APLD proving they can actually build these things on time and on budget. So hitting that first RFS milestone takes some of the risk off the table.
But the scale just keeps getting bigger.
It does. The second campus is Polaris Forge 2 in Harwood, North Dakota. This one has an immense total potential of 1 gigawatt. That's 1,000 megawatts.
And they've already locked down a big chunk of Harwood, haven't they?
They have. The first 200 megawatts of that capacity is already secured. It's a very sticky 15-year lease.
To an unnamed, U.S.-based investment-grade hyperscaler.
Correct. The market is dying to know who that second major customer is. But just the fact that the contract exists and it runs for 15 years, that's the crucial piece of information for now.
So let's do the math on that $16 billion number. That's the core of the bull case, and it comes entirely from these 2 deals.
It does. It's the 400 megawatts for CoreWeave and the 200 megawatts for the hyperscaler, for a total of 600 megawatts of contracted capacity.
Which works out to what, about $11 billion from CoreWeave and $5 from the hyperscaler.
Roughly, yeah. And what that represents is a multi-decade contracted revenue stream that is, in theory, highly predictable. That is, provided those tenants stay solvent and the facilities stay operational.
Okay, let's talk about what they're actually selling, because it isn't just land in a building, it's execution and strategic physics. The CEO, Wes Cummins, is very proud of their claimed speed to market.
He is. He says they've cut the standard build-out time for these massive facilities from 24 months down to just 12.
And he argues that execution speed is the single biggest constraint in the whole AI industry right now.
Right. If you can build twice as fast as your competitors, you capture the market share. But the true defensible moat, the thing that's structurally much harder for anyone else to replicate, is their strategic site selection.
This whole idea of stranded power.
Exactly. That's the secret sauce.
So explain that model in detail for us. Why North Dakota? I mean, why not build these near the major tech hubs in Virginia or California?
Well, because the AI industry is facing a genuine power crisis. AI workloads are so incredibly power intensive that they are straining the existing electrical grids in those high-demand urban areas like Northern Virginia.
Which is the traditional data center hub.
It is, but APLD avoids all that congestion. They strategically locate their facilities in places, primarily North Dakota, where there's just an abundance of underutilized power generation capacity. Think wind farms, gas plants.
So the power's there, but it can't get to the big cities.
Right. It lacks the necessary transmission infrastructure to send that energy where it's most needed. That power is effectively stranded.
And by becoming the massive primary consumer of that stranded power, they can lock in really cheap long-term contracts.
Absolutely. Those low-cost power contracts are the lifeblood of an AI factory. Power is the single largest operating expense. So they couple that power advantage with a really specialized design.
These facilities are built differently.
Totally. They're purpose-built for the incredibly high density requirements of AI chips, which can be 15 to 30 times the density of a traditional server farm.
Which means you need specialized cooling. Liquid cooling becomes essential.
It's the only way. And they're using the climate to their advantage. They leverage that cold North Dakota climate for what they estimate is 220 days of free cooling per year.
So this highly efficient design, it targets a best-in-class power usage effectiveness, or PUE. What's the number?
They're targeting a PUE of 1.18. Now, for you listening, a PUE of 1.0 is physically perfect efficiency, which is impossible. So 1.18 is extremely, extremely good. And it signals massive operational cost savings.
And APLD has actually put a number on those savings, haven't they?
They have. They estimate that this combination of cheap power, specialized design, and free cooling saves their tenants somewhere between $60 and $90 million in annual total cost of ownership.
Per 100 megawatt facility.
For 100 megawatts, yes. So when you look at the 600 megawatts they have contracted, that TCO saving becomes a multi-billion-dollar structural advantage over the 15-year lease term. That's why the tenants sign those long, sticky contracts.
But let me just challenge that moat for a second. If this stranded power is the secret sauce, what happens when the utilities finally, inevitably, build the transmission lines to get that power to the more profitable cities?
That's an excellent challenge. It's a core long-term risk.
Does their whole cost advantage just disappear in 5 or 10 years?
Well, the long-term contracts APLD signs, those 15-year agreements, are specifically designed to lock in the rates before that transmission infrastructure gets built. So they're protected for the duration of the current contracts.
The contracts are the shield.
For now. But the risk is that if APLD needs to renegotiate or expand beyond their current contract terms, the negotiating leverage could shift back to the utility, especially if that utility can suddenly service more lucrative markets. The long-term threat of transmission build-out is real, and it could definitely compress their future margin expansion.
Speaking of external factors, let's look at the industry and the regulatory environment. The power crisis is clearly APLD's main opportunity.
Yes, the fundamental market trend is that AI demand is accelerating far, far faster than traditional utility and grid infrastructure can cope with. This just validates APLD's model of finding power where infrastructure doesn't exist, instead of fighting for scraps where demand is already saturated.
But the regulatory landscape is, well, it's a mess of contradictions for a builder like APLD.
It really is. On the one hand, you have the Trump administration's executive orders, which are accelerating permitting. That's a clear tailwind. It supports APLD's claims of speed to market.
That's the good news.
The bad news is the U.S. imposed tariffs of 2025. This is a major headwind. These tariffs are on key imported construction materials, steel, aluminum, critical electronic components, semiconductors.
All things they need to build these multi-billion-dollar facilities.
Every single thing. So it directly increases their capital expenditure, their CapEx. The government is essentially making it easier and faster to get permission to build, but fundamentally more expensive to actually do the building.
How material is this cost increase for APLD's budget?
Well, for a project costing hundreds of millions of dollars per phase, even a modest 5 or 10% tariff-driven increase in materials costs translates into tens of millions of dollars in unexpected CapEx.
And that money has to come from somewhere.
Exactly. And given APLD's current liquidity issues, which we'll get to, that means more expensive debt or more shareholder dilution. The tariffs significantly raise the execution risk.
So to just summarize the moat here, the barriers to entry are huge. The capital, the power access, the specialized expertise. But the strongest moat is probably the massive switching costs for the tenants.
Absolutely. I mean, you have to think about it. These tenants are installing billions of dollars worth of custom GPU hardware, the entire computing backbone of their business, into APLD's custom-built liquid-cooled facility.
They can't just pack that up and move it.
Tearing that out, moving it, and rebuilding the power and cooling infrastructure somewhere else is financially and logistically just about impossible, hence the 15-year terms. It's an incredibly sticky revenue stream.
So their unique capability is that specific synergy, the blend of speed, the proprietary design, and critically, that strategic low-cost power location. No one factor wins on its own. It's the combination of all three. And as we analyze this business, we want to pause and give a quick shout out to our sponsors. Like and subscribe to Stock Analytics AI.
This deep research is what our members have come to expect. For $4.99 a month, get 500-plus deep dive videos on all S&P 500 stocks, with NASDAQ 100 coming next, plus members-only requested deep dives. Remember, members can add stock suggestions for future videos in the comments, and we will pick them up.
Chapter 2, Management Evaluation.
Okay, we've established the massive pivot they're undertaking. So let's look at the management team steering this highly capital-intensive ship, started with the CEO, Wes Cummins.
And his background is really unusual for a data center company.
It is. He spent 20 years as a technology investor and a hedge fund manager. He's not a traditional construction guy or a utility executive.
Which perfectly explains his key skill set, right? He's good at trend spotting, he executed this whole AI pivot, and most importantly, he's good at capital raising.
He's the guy who secured that massive preferred equity deal from Macquarie and is now executing this multi-billion-dollar debt offering that we're talking about today.
So he's fundamentally a capital markets-focused CEO.
He is. And for this phase of the company, that's necessary. APLD is basically a financing vehicle that happens to build things right now. And to his credit, he seems to recognize his own operational blind spots.
Yeah, he's hired experts to fill those gaps.
He has, notably the COO, Laura Lotrello, who has extensive operational experience from big companies like Lenovo and Honeywell.
So the capital allocation strategy is, well, it's pretty clear from the current crisis. Growth at all costs.
Everything. Every penny is being funneled toward CapEx for Polaris Forge. You shouldn't expect any common stock dividends or buybacks anytime soon.
No, not for a long time. However, there is one financial instrument that acts like a dividend for their preferred investors, and it's a massive part of the bear case.
It is. We need to detail the preferred equity they got from Macquarie Asset Management. It carries an extremely high 12.75% PIK dividend.
And that term PIK often scares sophisticated investors. Can you explain exactly what that means and why it's a sign of expensive, maybe even desperate capital?
So a paid-in-kind dividend, or PIK, means APLD doesn't pay that 12.75% coupon in hard cash. If they had to pay cash, it would just immediately make the free cash flow crisis even worse.
So instead of cash, they pay with more IOUs.
Essentially, yes. They pay that 12.75% by issuing more preferred equity to Macquarie. It's basically deferred compounding interest.
So the obligation just grows automatically, even if the company is bleeding cash.
Exactly. It causes the preferred obligation to compound at a really vicious rate. It's debt accretion that's disguised as a dividend. Let me run a quick illustrative example for you.
Please do.
Okay, so if the initial preferred obligation was, say, $500 million, compounding at 12.75% annually means that after 5 years, even if APLD has paid zero cash, the total obligation has grown to nearly $910 million.
Wow. It's almost doubled without a single cash outflow.
And that is terrifying for the common equity holder because that large growing preferred stake sits way above you in the capital stack.
And it gets worse, right?
It gets worse. The Macquarie preferred equity also includes a significant 1.8x liquidation preference. This means if APLD ever faces bankruptcy or liquidation, Macquarie has to be paid back 1.8 times their total compounded preferred equity value before the common shareholders get a single penny.
So this is exceptionally expensive capital.
It is. And it signals management's intense focus on growth at all costs, even if it comes at the expense of diluting the common equity holder's claim in any kind of downside scenario.
And this expensive capital leads us right to the most crucial financial health check for a capital-intensive business: return on invested capital, or ROIC.
ROIC is the metric that matters most here. It measures how effectively management uses the capital they raise. And you have to compare it directly against the company's cost of borrowing, which is the weighted average cost of capital, or WACC.
And right now, that comparison is, well, it's profoundly disturbing.
It is. The trailing 12-month ROIC is deeply negative at negative 4.01%. Management is currently losing money on every single dollar they invest.
And you have to contrast that with their estimated WACC.
Which is a stratospheric 26.12%.
26%. Let's break that down. A WACC that high implies extreme financial risk. What's driving it to be so high?
It's a combination of a couple of things. First, there's the risk premium the market demands for APLD's common stock.
Yeah.
But the bigger piece is the extremely high cost of their debt and preferred equity.
That 12.75% compounding PIK dividend is a huge factor.
A huge factor. But the market also has to price in the risk associated with this new $2.35 billion in senior secured notes and just the implicit risk of failure. This high WACC means that the company's hurdle rate for any new project is astronomical. They have to earn more than 26.12% just to break even on a risk-adjusted basis.
So let's just be very clear about the current reality. Management is borrowing money at a blended cost of over 26%. 4%, and they're investing that capital into projects that are currently losing 4% per year.
By pure definition, they are destroying value right now.
Correct. The entire investment thesis, the whole bull case, demands a violent and almost unbelievable inversion of this metric.
Bulls have to believe that once these facilities are fully built and that $16 billion revenue stream starts flowing, that the massive operational cost savings, the low PUE, the stranded power, will drive the ROIC up to 30 or 40% plus, dwarfing the high cost of capital. But the current state is value destruction, and that gap is the chasm that investors are being asked to fund.
And as if that ROIC-YRFC gap wasn't enough, we have what might be the single biggest red flag under management evaluation: insider selling.
This cannot be overstated. For a company like this, you need management to have their interests aligned with shareholders. Now, APLD actually has decent insider ownership, about 6.5%, which is typically a bullish sign.
But you have to look at the recent direction of travel.
That's the key. We saw heavy, consistent selling by the C-suite and the board in the weeks just before today's announcement of this highly dilutive financing.
The timing just looks profoundly opportunistic. Can you tell us specifically who was selling and when?
The selling looks coordinated. CEO Wes Cummins sold $6.1 million worth of stock. The CFO, Momand, sold over 137,000 shares in late October 2025.
And it wasn't just the key executives.
No. Multiple directors, Knottenberg, Benson, Hastings, and Lee, all sold large blocks of shares in that same critical 30-day window leading up to today's news.
And these are the only people with internal knowledge of the company's severe liquidity crunch, which we'll detail in the next chapter, that current ratio of 0.65, and the certainty that this highly dilutive financing was about to be announced.
They sold their shares right before the market reacted, with a 10% drop to that very news.
It's a devastating signal.
It is. Why would the people with the most intimate knowledge of the company's imminent financial challenges cash out right before what the bull case claims is the greatest AI infrastructure boom in history? It suggests they lacked confidence in the short-term equity price or believed the immediate dilution risk was just too high.
So for you, as an external investor, you have to ask yourself, why should I be buying what the insiders just sold?
Oh.
Chapter 3, Financial Health. All right, let's nail down the current financial reality that made today's dramatic financing news an absolute necessity. First, market capitalization. It's sitting around $8.37 billion.
But even that number is tricky.
Right. Because of the complex capital structure, all the warrants, the convertible preferred equity, it causes financial databases to report wildly different market cap figures. Valuation is difficult right out of the gate.
The complexity is intentional, but the underlying issue is the revenue reality, which we've dubbed the revenue valley. We saw rapid growth from about $55 million in fiscal 23 to $137 million in 24. But then it stalled.
Stalled completely. Growth to only $144 million in fiscal 25. That's a miserable 5.5% increase.
And that stalling proves that APLD is stuck in the gap. The old legacy crypto business has matured and is dragging, and the new massive AI business has not yet begun to hit the income statement in any meaningful way.
The costs, however, are hitting immediately and massively.
They are. The company is profoundly, disastrously unprofitable. If you look at the net margin for fiscal year 2025, it's negative 107.22%.
That's a staggering figure. Let's just put that in plain English. It means for every single dollar of revenue APLD earned, it lost $1.07. They are literally subsidizing every dollar of income.
And the loss consistency is the issue. The company just consistently burns money, resulting in an earnings per share and EPS of negative $1.16 in 2025.
And this profitability gap between the old stagnant revenue and the colossal immediate capex cost is what drives the next metric.
Which brings us to the cash furnace. This is the most terrifying metric for any growth company, free cash flow or FCF. And the trend here is accelerating exponentially negative.
Just how bad is it?
Well, in fiscal year 2023, the FCF hole was a negative $73 million. In 2024, it was negative $108 million. In fiscal year 2025, that FCF ballooned to an astronomical negative $772 million.
$772 million in 1 year. That negative hole is the existential reason for today's news. This company had to raise that $787 million from the equity draw and propose the $2.35 billion debt offering just to ensure it could survive the next 12 to 18 months of construction.
Survival is 100% dependent on continuous, uninterrupted access to external capital. If the capital markets freeze up, or if this debt offering fails to materialize on good terms, the company faces an immediate existential risk.
And that dependency is reflected in the critical liquidity red flag, the current ratio. This metric tells us if the company can cover its short-term bills, things due in the next year, with its short-term assets like cash and receivables.
A standard healthy company has a current ratio of maybe 1.5 or 2.0. APLD's current ratio is a dangerous 0.65.
And anything below 1.0 is a danger sign.
A huge danger sign. It signals a genuine liquidity crunch. They do not have enough cash and liquid assets on hand to cover their bills over the coming year.
That 0.65 ratio explains the desperation behind today's highly dilutive financing announcement. When your ratio is that low, management is forced into taking unfavorable terms. What kind of pressure does that put on their day-to-day operations?
It creates enormous pressure. Your suppliers might start demanding faster payment terms or even payment up front. Management might be forced to delay non-essential capex, or even worse, engage in distressed sales of non-core assets.
Like the cloud services segment they're already thinking of selling?
Exactly. That low current ratio is the immediate, unavoidable consequence of the accelerating cash burn.
And the debt side of the balance sheet is about to undergo a fundamental transformation. The current debt-to-equity ratio of 62% is already high, but it's completely obsolete now.
That proposed $2.35 billion in new senior secured notes will cause this ratio to just explode higher.
And that new debt fundamentally increases the financial risk. And crucially, it increases the ongoing interest expense, which just makes the cash burn problem worse, especially in a high interest rate environment.
They're basically trading liquidity risk, the 0.65 current ratio for solvency risk, which is that massive new debt load.
So moving to valuation, we can't use the price to earnings or PE ratio because there are no earnings, just losses. So we have to turn to the price to sales or PS ratio.
And APLD's PS is currently around 42.6x.
42 times sales. That is astronomical. For context, what's the peer average for data center and infrastructure companies?
Typically around 4.2x. So APLD is trading at a PS ratio that is literally 10 times the industry average.
So you have a market capitalization of $8.37 billion based on just $144 million in mostly stagnant crypto revenue. Why is the market willing to assign this stratospheric premium?
The answer is 100%, the $16 billion vision. The market is not valuing the company based on its current financials at all. It's valuing APLD as a project finance vehicle that has already de-risked the customer acquisition side. That $8.37 billion market cap is priced for absolute perfection regarding that future contracted revenue stream.
You're paying today for the revenue of 2030.
Exactly, which means traditional intrinsic valuation is impossible. A discounted cash flow, or DCF, model based on current metrics would value APLD at 0 or less, given the negative 772 million FCF.
So valuation has to shift entirely.
Entirely. It becomes a sum of the parts or project finance model focused purely on the NPV, the net present value of that locked-in $16 billion contract pipeline. And this is why the valuation range you see in the community is so extreme. It's a binary outcome.
Its targets reflect this. They range from a bear case low of $2.89,
which is the price if the execution fails and the debt crushes the equity,
to a bull case high of $43.70, which assumes flawless execution.
And that outcome, that huge range, it all hinges on 4 key massive assumptions that must be flawless. 1, the $16 billion in revenue has to fully materialize on schedule. 2, margins must flip violently from that current negative 107% to the anticipated 30 to 50% range once the low-cost power model is fully operational.
3, CapEx has to eventually stop. The cash burn has to end once the facilities are built. And 4, analysts have to use a very high discount rate, 30% or more in their models, to account for the extreme execution and liquidity risk.
If any one of those 4 assumptions fails, the bear case is activated. If all 4 are successful, the bull case of 4370 becomes reality. It's truly a financial game of chicken being played with the debt markets.
That concludes the financial fundamentals and the business structure. Now let's look at how the external market and its major players are betting on this colossal risk. Part 2, chapters 4 to 7, market sentiment, ownership, risk, and final conclusion. Chapter 4, market sentiment.
The market sentiment around APLD is, well, it's one of fascinating outright contradiction. On one hand, you have the professional analyst community. They are uniformly bullish.
So despite the negative 772 million FCF and the negative 107% net margin, the consensus rating is a decisive strong buy.
It is. Their consensus price targets range from $31 up to $43.70, which implies, what, 65% plus upside from today's price.
So the street has completely bought into the future narrative.
Completely. They trust management's ability to execute the $16 billion pipeline, and they believe this cash burn is just a temporary construction expense.
But the immediate market reaction to today's news, the huge equity draw and the massive debt offering, was the exact opposite.
Right. The 10.1% stock drop today is an unequivocally negative reaction. It's driven by concerns over the magnitude of the dilution and the clear, continued reliance on massive, expensive external funding just to survive.
So the street and the analysts are looking at the same information but using different discount rates.
That's a great way to put it. The analysts are focused on 2030 revenue, while the market today is focused on 2026 financing risk.
And this leads us to where the real battle is being fought, the short interest. This metric defines APLD as one of the most volatile stocks currently trading.
This is the ultimate battleground. The short interest as a percentage of float is astronomically high, 33.61%.
33%, that is massive. The peer average short interest is only about 6.5%. What does it mean when 1 out of every 3 shares available to trade is held by someone actively betting the company will fail?
It guarantees explosive volatility. The short sellers are sophisticated traders. They are focusing on the catastrophic present-day risk, the cash burn, the 0.65 current ratio, the heavy insider selling.
They believe the cost of capital, that 12.75% compounding PIK, will crush the equity before the revenue can save it.
That's the bet. But if they're wrong, they become the fuel for the rocket ship.
A massive short squeeze.
Precisely. If APLD executes flawlessly, and the market confirms that the $16 billion revenue is coming online, the shorts will be forced to cover their positions. A short squeeze of this magnitude, a third of the float, would send the stock soaring far past the fundamental targets. It would create a dramatic upward spiral.
But if they miss?
If APLD misses a major milestone, however, the shorts will be proven correct, and the equity value will be just devastated by that debt load.
And looking at the technical indicators, the immediate pain is obvious. The current price of $23.62 is now below the 50-day moving average.
Which sits at $26.89, yeah. That confirms the negative short-term momentum. The fear of dilution is winning the day right now.
However, if you zoom out, the long-term uptrend is still intact.
It is. The current price is still well above the 200-day moving average of $13.48. This confirms that the major move driven by the AI pivot remains structurally sound, even if the stock is being violently shaken by today's financing news.
Chapter 5. Ownership structure.
All right, so let's review who is holding the bag, or, depending on your perspective, holding the potential jackpot. Institutional holdings are actually strong.
Yeah, you see top investment managers like Vanguard, BlackRock, and Hood River in the top holding positions.
And critically, they were increasing their positions significantly in the third quarter of 2025.
So that gives a bullish counter signal to all that insider selling we talked about. Institutions are buying the dip while the management team is selling the rally.
It's a fascinating conflict.
Yeah.
But the far greater concentration risk lies not in who owns the shares, but in who owns the capacity.
This is the extreme customer concentration, and it's the primary bet the company risk for APLD.
And the risk is twofold. First, you have the legacy risk. 93% of current operating revenue comes from a single customer, customer A. If they leave or fail, the current business basically disappears.
But the future risk is even greater.
Yes. 100% of the future $16 billion pipeline comes from just 2 future customers, CoreWeave and that unnamed hyperscaler. This introduces just catastrophic risk.
So let's explore the failure modes here. What happens if CoreWeave, which has $11 billion of that contracted revenue, suddenly faces, I don't know, technological obsolescence? Or what if the hyperscaler breaches its 15-year contract?
The loss of either customer would instantly vaporize the bull case. The $8.37 billion market cap would no longer be supported by any future cash flow. And worse, given APLD's high-cost capital structure, the PIK dividend, and the massive new debt, they would likely face immediate default pressure because the expected cash flow needed to service that debt would just vanish.
They have absolutely no cushion.
None. It's an all-or-nothing bet on the operational health of two strategic partners.
And this forces us to return once more to that profound red flag of insider activity as it relates directly to management's alignment with this concentration risk.
And re-emphasizing the timing is crucial here.
Yeah.
The CEO, the CFO, multiple directors, they all sold millions in stock in the 30 days immediately preceding this highly dilutive financing announcement.
So the question is, if the future is as bright as that $16 billion backlog suggests, why would they risk missing out on the coming short squeeze and the subsequent rally?
It's the market's worst-case interpretation. That management anticipated this negative market reaction, they feared the dilution, and they prioritized cashing out before the inevitable 10% drop. It signals a potential lack of faith in the short-term resilience of the equity.
It introduces a level of doubt that you have to account for in your risk model, regardless of how good those contracts look on paper. Chapter 6. Risk Assessment. Now, let's synthesize everything into a robust SWOT analysis, drilling down into the key factors that will determine this binary outcome. Let's start with the internal strengths.
Okay, the strengths are all about the future potential. S1. The foundation is the 16 billion plus contracted revenue backlog. It provides visibility for over a decade.
S2. They have a proven rapid speed to market, cutting build times to 12 months, which is a major competitive differentiator in a time of extreme AI demand.
S3. Their proprietary tailored AI factory design high density and liquid cooled is exactly what the industry requires. And S4. The critical structural cost advantage that they get from the stranded power and free cooling strategy in North Dakota.
Okay, now for the weaknesses, which are all about the present-day reality. W1. The catastrophic cash burn, that negative $772 million in free cash flow.
W2. The subsequent immediate liquidity crisis, flagged by that dangerous current ratio of 0.65.
W3. The company is deeply unprofitable, losing $1.07 for every dollar earned. W4. It is currently value destructive, shown by the negative 4% ROIC being crushed by the 26% WACC.
And W5. Extreme customer concentration, betting the entire company on just two tenants. And finally, W6. The profound signal of heavy insider selling just before bad news.
Okay, now the external opportunities. O1, the underlying market is huge. There is massive, non-negotiable AI demand that will continue to strain grids, which validates APLD's model.
O2. The planned REIT conversion is a massive opportunity. It could potentially unlock cheaper capital and higher valuation multiples down the line.
And O3, the sheer expansion potential. Polaris Forge 2 has another 800 megawatts of capacity beyond what's already leased, providing a huge second wave of potential revenue if they successfully execute this first phase.
And finally, the threats, which are all interconnected and which really explain today's 10% drop. T1, financing and dilution risk. The sheer cost of this capital, the 12.75% compounding PIK dividend, the 1.8x liquidation preference, and the new $2.35 billion in debt creates a ticking clock that threatens to destroy all common equity value if execution is delayed.
Let's spend a good amount of time on T2, execution risk. The entire $16 billion thesis rests on flawless, timely, and on-budget construction, which is notoriously difficult in multi-billion-dollar infrastructure projects. What specific factors jeopardize their execution?
Well, there are several layers. First, you have just basic construction risk. These facilities are being built in North Dakota. That means harsh winter weather, potential labor shortages, and complex remote logistics. All of those pose persistent threats to that 12-month timeline.
And then there's the financial risk of construction overruns.
Exactly. If the actual cost per megawatt exceeds their projections, they will need even more financing, which leads to further dilution.
And those cost overruns are directly made worse by macro factors, specifically the geopolitical threats we mentioned earlier.
Right. The U.S. imposed tariffs of 2025 on construction materials, steel, aluminum, semiconductors are a direct material threat. They increase the cost of APLD's CapEx, which compounds the cash burn, which in turn increases the need for that expensive financing. It creates a potential doom loop.
And if APLD misses a ready-for-service date because of tariffs or weather, are there penalty clauses in those big 15-year contracts with CoreWeave and the hyperscaler?
Oh, almost certainly. These are complex, customized service agreements. Delays often trigger financial penalties, which would further erode their margins and could potentially give the tenant the right to renegotiate terms or even pull out of parts of the agreement. Execution risk is not theoretical. It's measured in immediate, significant financial consequences.
And finally, T3, macro threats. High interest rates are a direct and present danger. How do rising rates structurally worsen the APLD investment case?
Because they just announced $2.35 billion in new debt. Even if they manage to secure a fixed rate, that rate is going to be high because of current monetary policy. If rates rise further, or they need to refinance portions of their existing debt stacked down the road, their interest expense will skyrocket.
And that increased interest payment directly worsens the cash burn.
Accelerates the need for more capital and makes that 0.65 current ratio situation even more precarious.
It truly feels like APLD is playing a financial game of chicken. They have to cross this chasm of unprofitability before the cost of the bridge itself just collapses under its own weight. Chapter 7, Conclusion.
So let's synthesize all these findings. Applied digital is the absolute definition of a binary investment case. And both the bull and the bear arguments are incredibly strong, and they use the same core set of facts but just apply different discount rates.
The bull case is simple, it's elegant, and it's powerful. It focuses entirely on the future. APLD is a pure-play picks and shovels AI utility.
They have a $16 billion revenue backlog, which has de-risked the customer side of the equation, and they have a defensible moat based on stranded power and execution speed. Bulls see today's dilution as just a necessary temporary funding expense to bridge the CapEx gap.
And they target 65% plus upside based on that future profitability.
Then you have the bear case, which is equally powerful, but it focuses on the crushing present-day reality and risk. Bears see a company losing $772 million in free cash flow, currently destroying value, trading with 33% short interest, and relying entirely on the continued good graces of just two customers.
And critically, the bears point to the damning evidence that the insiders themselves sold millions in stock just before this negative financing news broke.
So our valuation summary just reiterates the central truth. APLD is an impossible stock to value using traditional metrics. It is a binary venture capital play that happens to be publicly traded.
And that's reflected in the extreme range of estimated value you see. From a near-zero outcome of $2.89 to a massive success of $43.70 per share.
And as of today, November 13, 2025, Applied Digital stock price of $23.62 sits squarely in the middle of this chasm of uncertainty. You have to remember, you're not buying value here. You're funding a multi-billion-dollar construction project. The 10% drop today reflects the market's rational and justified terror of the cost, the compounding debt, and that heavy insider selling.
So what does this all mean for you, the investor? The entire outcome really relies on one single factor: flawless execution. If APLD delivers the remaining 550 megawatts on budget and on time, if they avoid tariff-driven cost overruns, and if they keep those two major customers happy for 15 years, then the stock looks incredibly cheap today.
But, and it's a huge but,
Yeah.
if there is any significant delay, any construction cost overrun, or a single major customer issue, the crushing compounding weight of that 12.75% PIK preferred equity and the $2.35 billion in new senior debt will likely prove the bears right. The complexity of that capital structure means the cost of failure is the near total destruction of the common equity value.
And here's a final provocative thought for you to consider. Given APLD's desperate need for a lower cost of capital, you should track their future movements toward that REIT conversion very closely. If they successfully divest the cloud services segment and formally commit to the REIT path, that transition itself could be the most significant de-risking event they have left. Like and subscribe to Stock Analytics AI.
For $4.99 a month, get 500-plus deep dive videos on all S&P 500 stocks with NASDAQ 100 coming next, plus members-only requested deep dives. This analysis was generated by an AI system for educational purposes and should not be considered financial advice. Please conduct your own research or consult with a qualified financial advisor before making any investment decisions. Thank you for joining us on this deep dive.
Until next time.